Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the quarter ahead. As stocks get through September without too much trouble, so we'll ask the committee how to position now. Joining me for the hour, Joe Terranova, Steve Weiss, Sarat Sethi, and Shannon Sakosha. We will check the markets. We are in the red on the S&P and the Dow today, but it's a bit of a mixed picture. Shannon, I'm going to give you the first crack at this. So it's the last trading day of September, also of the quarter. We're going to be up 10 of 11 months. It's been one heck of a run. Now we want to know what October's going to hold. What do you think?
Well, we certainly expected September to be a little bit rockier, Scott. And so I think a lot of that is being pulled into October. We've got about 4 weeks ahead of an election that's going to be pretty contentious. We've got a very important jobs report on Friday. But similar to last year, and we started having this conversation sort of at the end of October last year, obviously not the end of September, but you start to look out and there's, the number of events that could potentially upset or be a negative catalyst to this market, start sort of ticking through those and counting those down. I think what we've seen is that we've seen the Fed be a little bit more aggressive perhaps than some of us thought, but yet it doesn't seem like any of this secondary or tertiary data that they're being given to digest really shows that they did that as a result of a greater deterioration in the economy than maybe they were anticipating. And so we've got the jobs report coming up. We have another month of what's likely to be pretty contentious campaigning from both of our presidential candidates. And we have a few questions outstanding in terms of what's happening outside of the U.S. Could that impact the U.S.? And then how do you start to position for 2025? But the closer that we get, Scott, to the election, and if this market can continue to have some strength, I think that what you're going to see is really positioning for 2025 rather than trying to make a lot of big moves into the end of 2024.
Joe, let's just keep it simple, okay? That's what Tony Pasquarello says we should do. Quote, in an attempt to not make the game any harder than it is, I'll reduce everything to this. The Fed is easing, and the U.S. economy is picking up speed. So the path of least resistance remains higher. Is it as simple as that?
Yes, it is. And one of the three major global economies is also contributing to fiscal and monetary stimulus. What the Chinese did last week, add that upon what the Federal Reserve has done here. Global central banks right now, for the first time since the first quarter of 2022, the percentage of global central banks where your last policy action was a rate cut exceeds 50%. Global central banks are behind stocks. You want to own stocks here. It's the right environment to own stocks. I think the question is, can you trade down in quality? And that's what's important about Friday's jobs report, because if you have a very strong unemployment report, then what I've been advocating for on the network, which is stay high up in quality, stay with the large caps. At that point, I probably have to react and be more open to owning some of the lower quality areas of the market and small caps themselves.
All right.
But overall, you want to own stocks.
Weiss, so the best of the best, right? No, we know some of them.
Yep.
They're always able to take sort of everything in front of them and distill it down to the most important couple of things to keep your eye on. Pasquarello seems to be doing that here. Yeah, he doesn't even mention in the election. I mean, it's not like he's not thinking about it. He's not letting it cloud his view of where we should be. It's just a bottom line business. Fed's easy. Economy's good. Let's play ball.
Yeah, so I agree in general with what he says. I mean, I do think it's an upward trending market, but it's never, ever that simple.
Oh, he doesn't believe me. I've simplified it.
Right. No, I know.
What he
and
said.
I get Tony's
He's
stuff.
not.
I read his note.
He's not doing that. But you could look at everything, all 30 things that were on the list of thoughts and ideas and this and that, and you can distill it, as he tries to do, to those two factors.
Well,
easy policy, good economy.
I reviewed all the economic data for the last couple of months, every single report, and I would tell you it's more mixed than that. It's not, you cannot conclude without any fear of correction your thought that the economy is in much better shape and is trending higher. You just can't do that. One of the reasons is you saw the inflation reports. They were somewhat disappointing. The knee-jerk reaction was they're disappointing. But the big thing and the big unknown is the consumer. And right now, it's not all that unknown to the big banks that see the credit card results. There's a difference of opinion with Visa and MasterCard, but they're definitely in different businesses, right? Credit quality is not really an issue for them. It is for the banks. And what they've said is that consumers are weakening. And what they've said is that consumer household debt is at the highest it's ever been. So those are issues. We've heard from the auto companies, and Sarat will talk about this in a little bit, that there's a weakening. Consumer still drives 2/3 of the economy. So again, for Joe, I've got some questions. I was unsure as to what you were saying. If we get a strong jobs report, then you're going to be forced to you're going to look at going to the lower quality.
No, is that what if you get a strong jobs report, you have to be open to the premise that the market will begin to allocate in lower quality areas of.
Okay, but let me ask you this: that if you get a strong jobs report, then it's unlikely the Fed goes 50. They'll go 25 because you don't start with 50 and then do nothing.
Look, I'm not excited about going to low quality areas of the market or small caps themselves, but I don't need the Fed to go 50. I look at Friday's report this way. If it's a weak jobs report, then you're talking about the Fed coming in with 50. If it's a strong jobs report, the Fed comes in with 25. I don't know that either one of those scenarios are bad.
But here's my point. The simplest way in this market, the simplest way to make money on an enduring basis is buying quality. Buy the quality names, stay with the quality names, and sure, they may underperform in September like we saw, but overall, you'll do much better off, unless you're a trader.
Sarat, Piper Sandler says today, we believe October will be more of a treat than a trick for investors. We believe pullbacks within the context of the long-term uptrend should be viewed as buying opportunities. Canaccord, don't fight the Fed. It's an opportunity, they say, to position for a fourth quarter rally, which they say is possible. I think most would agree with that. What's your view?
Look, I think September, when we talked about this in August, everybody was, hey, look at September, it's going to be really bad. Well, September wasn't that bad. So now the question is, how do we go into this for year end? I do think there's opportunity in the market. The economy is slowing, to Steve's point. We have to look at employment. We have to look at housing to see where they're going to be. And I think there are going to be pockets in the market. You have a tailwind with global central banks now cutting rates. So I do think you're going to have opportunities there, and I am more bullish than I am bearish.
Okay, so let's talk about positioning. As Canaccord, as I said, says now's not the time to fight the tape, but they present this as an opportunity to position for the potential of a fourth quarter rally. So on that note, Shan, I want to know where we should position. Pasquarello also points out that in this quarter, which is ending today, the character of the market changed, but the direction of the market did not. You look at the equal weight S&P, it's up 8%. Cap weighted S&P is up 5%. That's because mega cap tech didn't perform as well in this quarter as it did in prior ones. Sector winners, okay, utilities, best in the quarter, up 18%. That's the best quarter since 03. It's a new high today. Real estate's up 15%. Industrials, 11%. That's a record high. Materials and financials round out the best 5 sectors of this quarter. Technology's picking up the rear. It's only up 1%. Some would say that's a good thing because you have had the broadening. But I want to know what to do now.
Yeah, well, I think, Scott, I think the challenge is you're going to hear a lot over the next couple of weeks about value outperforming growth in the third quarter, and I think it's important that we don't conflate cyclicality with value. If it was truly a play on valuation, you would have seen much more pressure on the mega cap tech stocks, and instead, what you're seeing is that you're seeing that acknowledgement that there is some deceleration in those earnings for mega cap tech, and there's acceleration in earnings expectations for those other parts of the market. But that doesn't mean that you necessarily need to have a binary decision on owning technology versus some of these other sectors. I think you're still seeing some of those thematic tailwinds that we're talking about, Scott. You're seeing low rates continuing to drive, obviously, real estate and utilities, but you're also seeing, maybe, that's also driving financials. The real estate experience from a credit loss perspective isn't as bad as people were expecting. So you see real estate and you see banks getting a little bit of support. You look at industrials, you look at materials. That's on a reacceleration of this theme around reshoring. So I think that there are a lot of places, to Sarat's point, where you can position for a still resilient U.S. economy, which is likely to continue to benefit from this cyclicality. And that if there is meaningful additional pressure on some of these technology and comm services winners, then I would expect that it's likely that investors would come in to pick up some of that. Just given the fact that there is nothing necessarily pointing to a protracted weakness for those stocks, just an earnings deceleration.
I'm not presenting this, Joe, as binary. It's not like one or the other. It's a matter of, look, you had outperformance by these other groups in the quarter. As we said, equal weight beats the cap-weighted S&P. We haven't been able to say that in a long period of time. Now we've said it. And if you look at the groups that outperformed, I simply want to know, not either or, it's what's going to get you the best returns over the last quarter of this year. Is this trend intact where equal weight beats market weight or not?
I sure hope that it is, but look, I think that it's important to understand that for the broadening out to continue, you're going to need further evidence of one of two things. Number one, the Federal Reserve, to your point, Steve, is there with more aggressive rate cuts than maybe the market is expecting, or at least meets the expectation. In lieu of that, if you don't get that, then you need stronger economic data. I'm not in a place where I'm ready to say to myself, okay, as it relates to risk to reward, that's where I want to look towards. I want to look towards those two things. Even though quality is a factor in this quarter, has underperformed the S&P, underperformed small caps, I'm still looking to stay high up in quality because I think that's going to be important as we move towards the end of the year, remaining high up in quality. The other thing that I think is important real quick is, and you know that I believe this, I believe when you go into the fourth quarter, you want to own stocks that are showing strong performance year to date. You want to buy that momentum. You don't want to sit there and try and buy the laggards.
Well, year to date, or what about month to date?
I think you're looking at year to date.
Year to date.
Year to date? I'll tell you why year to date is important. This month is a significant month for mutual fund managers. This is where the tax loss harvesting happens. And that's
You mean October.
This month.
Yeah.
The month of October is where that tax loss harvesting happens, and it happens based on where we are for the year. I don't think you want to step into those laggards.
What about lately? Because the misnomer here is that, okay, tech has not performed as well as some of these other sectors in the quarter or mega cap. All roads always lead back to mega cap. But Sarat, if you look at other tech names month to date, Oracle's up 19%, Palantir's up 17%, First Solar's up 12%, Jabil, Micron, AMD, Salesforce, IBM. All of those stocks month to date are better than any of the mega caps. Like your Oracle, top of the list, 19%. It's not like tech hasn't done well. It's just the most marquee of names haven't done quite as well.
We sat here in the first three quarters and said you could have the market go up and you could have cap weighted be less than equal weighted. We would all be happy there. I mean, we wouldn't say, hey, you know, the worst case was that if all the big caps didn't do well and the others did well, but you wouldn't have any indication in the market. So I think this is good, and we need more broadening. It doesn't mean to say the large caps are not going to, the high quality that Joe's talking about can still do well. You just have to pick your spots and say which of those stocks are going to do well.
You've been talking about names like Palantir, up 17, as I said. First Solar's yours, AMD, up 11. Chips have been squirrely, but you know, you take that. Anybody would.
Yes, we also added Oracle several quarters ago. Again, examples of going a little bit outside of the Mag 7, looking for the opportunity in the technology sector, finding companies that have strong momentum, and I think that momentum stays in place. I don't think that message is that the Mag 7 is so bad. I mean, when you look at the Mag 7, tell me that they look so awful. Meta is near an all-time high. Apple's all-time high is 237. What is it, 233 as we're sitting here right now? So I think, to your point, where you started all of this, it's not binary. It's kind of a universe of all. And if you want to kind of lean in one particular direction over the coming quarter, you need to have the evidence. You need to have the evidence that what we've witnessed in this current quarter can continue in the fourth quarter. I think it's guilty until proven innocent that this could extend itself into the fourth quarter.
You know, I just think it's difficult, you know, following on what you said. Take CAT. I look CAT every day, and the reason I do is because I messed up trading in it. You know, I sold at the wrong time. I bought at the right time, just sold at the wrong time. And right now, you've seen the multiple, the PE increase by 50%. I mean, that's kind of alarming. So now they have to show that they can produce the earnings to support the multiple. I think that holds true with the other industrials. Now, the market's been discriminating, and we take a look at the name we talked about here, Cliffs. And Cliffs has done nothing but gone down this year. So going back to your question as you started, you asked Joe, if I knew the answer to that, and the reason why I don't move off my positioning is, number one, I don't want to pay taxes, but put that aside, is because I don't know the answer. If tech will I don't want to say come back because it's doing well, but I'd also be alarmed if tech led the market every single month, every single
No, but it
year.
hasn't. That's
wouldn't be a good
why.
thing.
How about,
Right.
How
So
about this?
That's positive.
Okay, how about this? Because people try and knock mega cap tech in a sense for the gains, suggesting, well, it's multiple expansion. That's really been the bulk of it. You take a look at what the multiples have done.
Yeah.
UBS has a really interesting notation today where they suggest that mega cap tech plus, that's what they call it, is cheaper today than it is in 2021, than it was in 2021. They say the largest 6 tech plus stocks are up 36% year to date, 43% since their 2021 peak. While one may incorrectly assume that these stocks are expensive as a result, gains are largely the result of earnings improvement, while multiples remain 5 times lower than 2021 levels.
And even if you look at it another way, they're within their 10-year average multiple.
So why do I keep hearing that mega cap tech's expensive?
Well, you're hearing from people that don't own it. That's why you're hearing from people that sold it or people that are underweighted. That's who you're hearing from. I think they're cheaper because what you're not seeing the earnings is the growth they're paying for in advance because they have these huge balance sheets and they are expending or going through CapEx for AI and other improvements, which will drive, to me, ultra growth going forward than what they've had. So I do think they're cheaper than they've ever been. I do still think they're the safest stocks that have been out there. Even if they get broken up, right? And we keep seeing these lawsuits and the track record of the government's not great. But even if they get broken up, the parts are greater than the whole. So I just see safety in these names. You know, there are some risks like there are in any company. But for me, it's safe, it's cheap, and that's why I'm staying there.
You got all of them. Apple, Amazon, Alphabet, Microsoft, Meta, NVIDIA.
Yeah, just not as big as the market. I mean, I have 60 stocks in my portfolio. But to your point, I think you can be in them, and I've said this all year long, but you can also be in the others. And there is safety in a Google and Meta because if it gets broken up, there's so much more value there that you're not seeing because of all these lawsuits that keep on coming. So I do think the other part, Joe, to some of the stocks that you like too, is that the trade from AI is moving over to other technology stocks, to other areas, like software. You know, people put software out, so your companies like the Oracles, the Salesforces, the Workdays, nobody paid much attention to them, but they have earnings growth as well, and they can do well, just as well, if not better than the rest of the
Do
market.
you think the outperformance comes back for these stocks between now and the end of the year, mega cap?
No, I think the outperformance is going to be in some of the other areas. I don't think these stocks are going to get killed because people are hiding in them, but I don't think you're going to get new money.
I mean, I'm not suggesting they're going to get killed at all.
I don't think they're going to outperform the market. I think they're going to do fine, but not as well as the rest of the market.
If there's one concern for mega cap technology, if there's one concern for the Mag 7 itself and technology underneath those Mag 7, it's earnings, because the comps are really hard in this upcoming quarter. And I think that's important to understand. You're talking about a very high bar that you're going to have to
Because last year was the year of efficiency,
last year was the year of efficiency.
So,
and we're now comping against some historic numbers.
You guys been, I mean, most people have been looking in, you know, what's been happening with China as we're talking about tech and some of these tech names. We could put up any number of them, Baba and whatever, PDD and Baidu and some of these others, especially the tech ones that have been ripping. It's the biggest one-day rally since '08. The MCHI, that's the MSCI China ETF, best week ever last week. FXI, large cap ETF, best week ever. Weiss, Wolf says the CQQQ, that's the tech ETF, is overbought. So what? Could persist. Plenty of room to run.
Yeah, look, I think there's room to run on sentiment, but I still think that the risks are substantial. Just because China's easing, they're so upside down financially with the banks that they've got a recovery to do. The Chinese populace has been burnt, and they've been burnt by these wealth management schemes they've gone into that are now belly up. So it's traditionally a saver society. I think they do a lot of saving before they do a lot of deploying of capital. So I'm not so sure. And then there's the inherent risk with the very structure of what you're buying. You're buying variable interest entities that own no assets. They're domiciled in the Caymans, and they only own part of the revenue stream.
So you don't believe in the gains that we've seen over the last week?
I believe the gains we've seen because that was a bazooka they came with.
So why does it stop here?
Well, I think it's got a little more to run, but in order for it to keep running, you're going to need to see earnings pick up.
You don't agree with do you agree with your guy who says buy everything China related?
Look, you know, it's first of all, he's been in BABA for a while, you know, and he's been right? So he stuck with it.
He wasn't talking like he thinks that now we have to worry about other issues. It's like a seminal moment in the investing psychology of how to view China for the first time in a handful of years, when all I've heard is doubts and it's uninvestable and this and that and the other thing.
Right.
He pounded his hand on the table and essentially said those days are over. This is a game changer. What they did.
First of all, there are a couple differences between Dave and everybody else. Dave will take incredible risks, right? Defined risks. He knows the risk he's taking and be able to move out. Even though China's not so liquid, he'll be able to move out very quickly, and you won't know when he does it because he's not coming on air to tell you.
I understand, but he's not going to come on a few days ago and say, it's everything this, and then today he's
high integrity, so he believes that now. My point is that there are defined risks there that the normal investor shouldn't be taking, and I've identified them with you. Now, what happens if they go to Taiwan? Now, we don't see it today. What happens if they blockade it? Are we going to see what happened to Russia in terms of the stocks and commercial enterprises there happen in China? So I do think it's got some runway, but you just got to be aware of the risks.
What about the idea of all I've heard when it comes to international markets? It was more than a year ago, Gunlock telling me India's the place to be. He crushed that. You said India crushed that. Now that the China dynamic is changing, do fund flows go more to China than they do India, taking a little bit of the steam off of that trade?
I think some will go to China, but I also think that a lot just won't go to China because of the political atmosphere there and because of the unknowns that I mentioned. So it's definitely not a market that everybody can go into.
I can tell you over the last several days, this has been very supportive for emerging market risk assets, in particular for emerging market bonds. People now are feeling as though with stronger emerging market currencies, this is a place to go. I think sentiment and positioning, we're in the perfect place for this to have a little bit more durability than just what I've heard a lot of people say, which is this is a trade.
No, I think it's a long-term trade.
And I think the way you're getting the way you're getting exposure. I mean, I know I'm looking at it. I'm saying to myself, what do we have in the ETF that gives us the exposure to this monetary and fiscal stimulus? Right now, it's really just one steel name. But I think you're going to get exposure with companies here, domiciled in the U.S., that are going to benefit from business in China.
They're the ones that's why Weiss started the conversation. Now he's looking at CAT. CAT's up a lot since the news. Freeport is up a lot since the news. Wynn, Las Vegas Sands got pops immediately on the news. Irrespective of what these stocks are doing today, you can look at the chart from the announcement.
I mean, you will get global companies getting it, but I think the commodities, we've talked about commodities before, where we're buying tech resources in Freeport based not on what China's going to do, but based on supply demand. This is a huge tailwind to that. So you can add the steel stocks in there, the copper, the aluminum, and the margin for them. I mean, just turning the switch gets their earnings up so much higher than kind of moving a big ship.
Let me ask you this before we take our break. How long have you owned General Motors before last week?
Too long.
How long?
Over 5 years.
Over 5 years?
It's been a horrible investment.
So, what made you finally sell it?
When it was 48,
you sold it last week.
I did sell it last week. $48. When you look at what's happening, I mean, I didn't know what was going to happen today, given Stellantis and all the others, but the consumer's slowing. You've got a huge amount of supply of autos. It's not just GM. It's Ford. It's everybody else is coming there. I just think you've got peak earnings there, and they're reinvesting so much money into products we don't know if they have a return on investment. So I made money this year. I lost overall to the market, but I'm kind of taking the money off the table and saying, hey, I really don't want to see the stock round trip in the 20s and 30s again.
Did what was it, a week ago or so that Jonas at Morgan Stanley, he downgraded a bunch of these names, I think General Motors included, correct?
General Motors, Ford, yeah.
Was that the nudge?
No, we were looking at this before that as well, and that just confirmed where we're going, and now you're seeing even more information coming auto's a really tough place, especially as the economy's slowing.
Okay, so we'll take a quick break. I got to move from Joe, too, but we'll save that. We'll do that ahead. I promise you that. We'll do our calls of the day coming up next as well. Got a call on Disney. We'll get to that. Autodesk. Barron's has an interesting cover story talking about the healthcare space, which we will trade the banks to. Earnings not that far away. We're back after this. Let's do some calls of the day. We start with Disney today. Got upgraded Surratt to buy from neutral. Seaport initiate $108 the price target. Mea culpa, they say, on their outlook for Disney now that there are better macroeconomic underpinnings to the story. What do you think?
We've liked Disney for a while. It's a true value play. You're going to need a couple of things. You're going to need catalysts in terms of earnings, streaming, and you're going to need to know who the next CEO. So these are one of those. This is a stock you want to own before the catalyst. Just don't know when they're.
Let's do Autodesk. Top pick. Morgan Stanley, Joe. $320 the price target. They did a deep dive on the margin opportunity that they have. They said it only increased their conviction in the upside earnings. They make it their top pick. Reiterate overweight as a robust catalyst path to improve fundamentals and investor sentiment. Frames a favorable entry point right here. What do you think?
I think August 29th was a critical moment for this company. I said before that they needed to come out with a very strong earnings report and to show shareholders that potentially there was a trough in place for revenue growth, for key free cash flow generation, and for margin expansion. That's exactly what this company did. They're in a good position now on the other side of that. They're 13% below their high in 2021. They're in the sweet spot in software. I'm staying with the position.
All right. Shan, so Barron's this weekend, cover story, healthcare's magical moment, they say. Sector's been bouncing back. They say many pharmaceutical and biotech firms still look alluringly cheap. Now you've got rates coming down, right? Fed's cutting rates, cost of capital is coming down for a lot of these smaller biotech firms. What do you make of this space here?
Well, we're on the precipice of an amazing amount of innovation in the healthcare space, Scott. And so whether that you express that in pharma and biotech, you've got immunology, oncology, on Alzheimer's. And importantly, it's not, you don't necessarily need to buy the smallest biotechs to have that exposure. You can get exposure to a really deep pipeline in some of these major pharma companies. Admittedly, some of them have had some meaningful price appreciation due to GLP-1s. You also are just seeing, there's been so much emphasis historically on managed care, and now you're seeing much more emphasis on pharma, life sciences, tools, consumables. From our perspective, there's so much here that's probably untapped and that's probably undervalued in the pipeline of many of these companies.
Weiss, isn't this your moment? I mean, for somebody who once liked profitable healthcare, not that long ago either, is this the moment, as Barron suggests, a magical one?
We've seen the indices have nice moves, right? Throughout the year, they've had nice moves because they were left for dead. And their underperformance has been just incredible over, sustainable underperformance has lagged history for a period of time. So I've got nothing wrong with it. I've considered buying the indices, the IBB, but I don't want to buy the individual stocks because it's just too hard to buy the emerging companies. You have to own too many of them. And Amgen, something like that. Yeah, I'd look at Biogen.
AbbVie. Why not these? You know the space really well.
I do. And I've done well by staying away from it.
Humana.
Well, so broadening out.
United Healthcare.
Yeah, I mean, look, I made a little money in both, but gave up a lot of money in United Healthcare. I mean, that stock's been exactly what I thought it would be. And I think it may be the time to go back to it because it's still not an expensive stock. They've still shown they can manage to it.
So, what about you? You have UNH, Illumina, Bristol, Thermal, Fisher, J&J, Zimmer, Merck, GSK?
I would say high quality versus kind of, to Joe's term, lower quality companies. So the high qualities of the Thermo Fishers of the world, Danaher's, those are really high quality companies. Lower quality, let's see what happens. Bristol had some good news last week. J&J's a recovery story. United Health is, let's see where that one goes. So I do think there's opportunity there. They are cash flow positive, all these companies. You just need catalysts in terms of earnings and multiple expansion.
You're underweight in the ETF relative to market. What are you thinking about these days?
Listen, do I want to increase the exposure to healthcare? Without question, I believe that healthcare will be disrupted by technology in the coming years for sure. But the underperformance, as Steve cites, it's real. I have tried. The month of September, it's one of 3 sectors that are actually negative. I bought the XBI, sold out of that. That actually worked out well selling out because you haven't had some follow through. And think about the popular healthcare names, okay? Think about Merck. Think about McKesson. I own both those names, I sold them. Right move to sell them because they've gone down even more. Think about Pfizer. Everyone thought that this was the moment for Pfizer. That hasn't worked. So the ETF has stayed kind of high up in both the quality and momentum spectrum. We own Eli Lilly, we own Intuitive Surgical, we own Stryker, and they've all worked well.
See, I'm concerned about Lilly because now you are seeing real pricing wars in weight loss drugs. And so what happens if Lilly's got to come out as the leader in the group, I mean the overwhelming leader, and say, hey, you know what, we got to cut estimates because our margins aren't going to be what they were, what we forecast. So I think that's a real risk to the group.
All right, up next. Hunting for yield. Investors driving one area of the market to an 18-month high as they look for ways to play future Fed rate cuts. Our Pippa Stevens following the action in today's ETF Fed. She'll do it next. Let's do this move from Joe. You bought EQT, and you did it this morning. Why?
Back in EQT once again, all I've needed to get back into this name is an incremental positive performance for natural gas prices itself. It begins there. This trade is not about natural gas pricing itself. This company's up 267% in the last 5 years, while natural gas is only up 27%. This is about power demand. This is about the need for data centers to utilize electricity, and natural gas is going to be critical in that. We've seen significant replacement, coal to natural gas. I think that's not going back anytime soon. EQT is perfectly positioned to the Virginia data centers, and that's going to allow them to really profit over the next several years. This time, I think I'm going to hold this position.
Okay. Let's talk about some winners and losers for the quarter. We said last day of September, last day of Q3. Sarat, PayPal, it's woken up. It's up 35%.
This thing took a while, though, but you've got new management team there. They're focused on really increasing their earnings, increasing on usage. The stock's got a run. There's got momentum behind it. I like it.
Illumina is up 25. Blackstone's up 24.
Yeah,
in the quarter.
Illumina finally resolved the Grail issue, so they do have good products. New management team. I think that's going to be good. Look, Blackstone, KKR, Apollo, these are all great ways to play asset allocation that's happening in all the big wirehouses. I think the tailwind behind these companies is huge. Not only do they have private equity and real estate, but they've got all the distribution too.
Of the losers on the list, Qualcomm's down 15%.
Yeah.
You sticking with this?
I am sticking with it. I mean, they had a great run before that. I still like where they are. Apache is one that's on my watch list that I think might be probably coming off. And LabWest has earnings tomorrow, so let's just see what they have to say. They got a little bit ahead of themselves, and the stock got crushed.
Weiss, you've been adding to Vertiv, and it's up 14% in the quarter. Leidos is a new record intraday high. Today, it's up 11% this quarter.
Yeah, Leidos still has a long way to go, as does Vertiv. Vertiv, of course, the cooling racks for data centers. Joe just mentioned them. Growth there is just exponential. Leidos is, you had new management come in about a year or so ago, and they've just done a phenomenal job, and I think it's a cheap stock.
Now I'm gonna give you the business. What's up with QXO, man? You keep singing this company's praises.
You
the
love Brad
management.
Jacobs.
I know. No, let me give the numbers first. Sure. Let me give the numbers first. It's down 78% in the quarter. That's the third straight quarter of double-digit declines. So what's happening here?
Yeah, I don't know who the fools were buying the stock at 100, 150, 200. I got it at 914 on the pipe that they did. And so I'm up nicely. I added to it at 11 and I added to it at 13.
Okay.
So when it's traded, it's, look, they've still got to announce their first acquisition, still trading roughly 2 times cash. But I don't know what people were thinking about when they were buying it at those levels. It was asinine. They should do some mental.
But you're as bullish today on QXO and Jacobs as you were when you bought it at sub 10?
I am. It's going to take a little while to play out, as I said then, but he's consolidating the building products industry, adding technology, same game plan he's run with those other industries like United Rentals, waste management, trucking, third-party logistics. So, yes.
Okay. Finals are next. Shannon, what's your final trade today?
Financials. We anticipate that there's going to be an increase in capital market activity in 25.
All right, good stuff. Thank you for that. Sarat, what you got?
American Express got a great tailwind with the consumers, high-end consumer spending. I like the stock.
All right, Weiss.
I'm going with Vertiv. I'm going to stay there. It's got a lot of upside.
All right, stock you've been buying, as we said. Good performance. And Joe T.
I love the e-commerce thesis. You go with Amazon, you go with Mercado Libre at today's final trade, which is Coupang.
All right, we will see what this market does. Maybe we can finish positive to end the quarter and this month. I'll see you on the bell.